Thanks for joining. So this is our Exit Readiness webinar. We're going to be covering a bunch of ground with Nick and Simon on the call. Just a few intros to kick off. So I'm Steve. I head up the tech and high growth team here at Parry, also an audit partner, and look after a lot of our scale ups in the portfolio. Obviously seen a lot of companies coming through our portfolio from early stage all the way through late stage into exit transactions. So we see the full cycle of companies going through the rounds. And joined today by Simon and Nick. Nick's actually a client, Parry, CFO of Ravelin, and Simon is a partner in our transaction services team. So I'm going to hand over to Nick and Simon to do their own intros, and then we'll get into some of the content.
Great. So let me just quick off really quickly. Simon Nichols, really glad to be here. So as Steve mentioned, I head up our transaction services team here in London and South East at Parry. We do an awful lot in terms of due diligence, both buy side and sell side. And the past 18 months, we've been doing a lot, both in terms of early stage exit readiness, vendor assist, and also slightly later stage vendor due diligence. And we'll be touching more on the latter, but also a bit on the former and the sort of preparing for sale. We worked with Nick and his team starting about this time last year on their sale, which was a really important deal for all of us, and actually one of the first branded Parry vendor due diligence exercises as well. But let me just hand over to Nick, and then we can explore everything about that in a bit more detail. Nick.
Yeah, hi everyone. Nick Lally, CFO here at Ravelin. So Ravelin is a fraud detection company. We work with online retailers and merchants to detect fraud at sort of the checkout. We started off looking at payment fraud, and then over the years we've added a number of other different types of abuse products that help merchants protect against things like refunds abuse, returns abuse, supply side fraud in marketplaces, customer authentication, and yeah, we recently sold to Worldpay. Before starting Ravelin, I was CFO at a company called Halo, which was one of the first taxi apps here in the UK. You may remember that before Uber, some of you may. Scaled really quickly there, and I guess took a lot of the learnings about what to do and what not to do around growth and raising money and things like that when we started Ravelin. And then prior to that was in another tech company called Canonical, where I was one of the early employees, and we scaled from 0 revenue when I joined to about 50 or 60 million in revenue when I left, and I was employee 40 and I left when we were about 500 employees. So had a track record for the last pretty much 20 years of working in tech companies here in the UK. Before that, I worked in banking in Australia. So yeah, that's a little bit about me.
Cool, thanks. Really awesome joining us today, Nick, and I hope to hear some good insights from this transaction which just completed this year. So just to give everyone a bit of an idea on the structure, I'm just going to run a Q&A basically with Nick and Simon, sort of roughly structured around kind of preparation phase of going into a transaction, and then actually the phase of getting into market and kind of actually dealing with the transaction itself, talking a bit about the type of advice or structure of using advice during the transaction, and then kind of summarising on key takeaways. I will be looking at the Q&A throughout. So I think the best thing, to be honest, on these webinars normally is if you just drop the questions in as we go, and I can weave them into the conversation as needed. If it's obvious to pick up a question at a certain point in the conversation, I'll drop it in live, and then we'll cover it off. Otherwise, I'll come to them at the end. So, so just in terms of opening, I think where we wanted to start was around the preparation kind of phase, really, and interested in your views, Nick, on how you felt Ravelin were prepared in going into this transaction. What maybe a bit of what you had done in preparing over that period before the transaction, and then maybe what would you have done differently if the deal was coming around again? What would you have done differently in preparation phase? Yeah.
So yeah, I think we started quite early in that we had a general idea about when we might want to look for an exit, and we had early stage investors that had doubled down on their investment throughout our various different funding rounds. They'd been with us. Passion Capital had been with us for almost 10 years. And so whilst there wasn't pressure from investors to have an exit, we know that the VCs need to return capital to their LPs, right? And so we had some general idea about when that timing might be. And so a few years out before that, we really started to think about, well, what will an exit look like? What will the timings be? And what can we do ahead of time to make sure that we're really prepped and ready for this? We kind of did a few different things. So if you think about any time you're trying to sell anything in your business, you kind of have a sales team and a marketing team. And so when I think about this, your sales team is probably the banker that you choose, and they can help you at the point where you actually say, right, we're in market, let's go to market. But there's a lot that you can do beforehand, and that's probably more what your typical marketing team would be doing. And so in the lead up to the timing of kicking off a process, we decided to be a bit more vocal on social media, a bit more vocal on LinkedIn, writing blog posts, having customer testimonials on our website, explaining big customer wins. When we finished 2023, which is the year before we kicked off this process, we did a press release about our growth and our earnings and things like this. And that actually got drummed up a lot of interest. I actually, on the back of that, got a lot of emails coming in from investment bankers saying, have you thought about an exit? So that was sort of one of the tactics that we used really early on. The other one was, I guess for the last 3 or 4 years, I've been speaking with several different investment bankers in that time. And I think that's really crucial. As much as you don't want to sort of tell the market that you're looking for an exit, because, there's a saying, good companies get bought and not sold. But I think it's great to make those introductions early. And the reason for that is they're going to be the ones that eventually will introduce you to the prospective buyers. And so we did, I probably met dozens of investment bankers over the past 3 or 4 years, and each time they want to be useful because they want to be the ones chosen to lead this transaction. And so they can be really helpful in just saying, well, who would be the sort of the universe of companies that are likely to buy you? Let me introduce you to their corp dev teams. And so these corp dev teams are sitting there in these organizations. Their sole job is to go out and meet companies. And so you'll always get a meeting with these corp dev teams, especially through an introduction from a banker. And it was great to sort of seed Ravelin out into the market, to find out who these companies are, to get an introduction to them. In many cases, you're doing it 2 or 3 years beforehand. They might find out about what your revenues are at the time and things like that. And they're able to then track your progress over time. And so if they can see that progress, it gets them even more excited for when that timing is right and you are in market and selling. And so that was the second thing. And the third thing was more around the stuff that we're talking about today. So how do we prepare the business and get that ready in a state for an exit? And so one of the things that we did early with Cooper Parry, we took on your vendor assist program, which is a desktop review of all the things that are likely to crop up in due diligence. And at a very high level, your team goes through to ask a bunch of questions. We spent a few hours in interviews with you guys, running through things like tax and permanent establishment risks that might exist, and accounting treatment and growth and things like this. And from that, you delivered a report to us saying, here's some really high risk areas, high level risk areas that you may want to sort of drill into and do some more work on. And so on the back of that, we engaged Cooper Parry to help us with some permanent establishment risks. We had a sales team in Germany that was flagged as a potential risk. Your advice was that we needed to set up a German either branch or subsidiary there to help with that. And so that was part of the early process for us, was let's try to tick off what all of those risks are and see if we can buckle those down so that before we go into an exit process, we're going to be able to avoid any of those potential price chips or risk areas that might crop up as you flow through that exit.
Can I just on that? I mean, that's hugely helpful to hear. I guess my questions would be around the timing of that. We're very our thoughts here are it's never too early to start this sort of informal prep for sale, exit readiness, whatever you want to call it. And this doesn't need to be a sort of massive exercise, but it's as you intimated there, it can be a tailored, brief, concise piece of work, but it flushes out the sort of red flags and the things that you perhaps need a bit more time to deal with before you go anywhere near buyers. And dealing with doesn't necessarily mean fixing, but at least having a plan or being on the front foot with the messaging or starting the journey of doing things. I mean, what sort of time scale in advance of the deal did you start this? And do you think with hindsight it was early enough?
Yeah, so we started this in probably Q3 of 2023. And I think had I had my time again, I'd probably do it another 6 months earlier. I would have given myself at least a full year ahead of time to prep. So some of the areas, like for example, the German permanent establishment issue that risk that was highlighted, we hadn't quite gone through the full process of setting up a German branch by the time that the exit started to happen and we got deep into due diligence. And I think that had we started that earlier, it would have been one more item we could have ticked off. Also, I think as you, and I'm sure that we'll discuss this more at length around the vendor due diligence report that we engage you to do. That goes a few levels deeper and really highlights the things that a desktop review or a few hours of interviewing sort of wouldn't pull out. That's when you guys troll through, invoices and things like this and what the issues are there. And that's where I think had we started that slightly earlier as well, we would have been a little bit more prepared going into due diligence. But that said, I think the overall process of first doing this vendor assist and then doing the VDD reports on both tax and accounting was instrumental in making it really easy for us to flow through that exit process and the due diligence process.
We'll come back to this this mix of VA and VDD as we get a bit more into it. But just on the preparedness point again, just interested in how you felt around the timing of, I guess, the actual metrics in the business as well, because it's all very well wanting to do an exit, but there's also the sensitivity around what are the key trends in the business, how are they tracking, what's the right point to prepare if you're not sure exactly how those trends are going to play out, because maybe prepared 12 months before, but actually the trends are not in the right place when you get there. Like how are you monitoring that, I guess, in the business, and was there an obvious point of those trends coming together to move towards the exit path, or were you still somewhat just in planning phase when it really came to market?
Yeah, so when we finished 2023, we took a look at the business and we thought we've had a really good year from a sales point of view. We had onboarded a few large customers. We had good revenue growth overall. When we looked at our profitability, we could see good line of sight to getting to that break-even point as a business. And we thought, and our business is one where we have our average deal size is about 250K. We have clients that are several million pounds in size. And so we're somewhat elephant hunting. And so if we have good line of sight to a bunch of elephants that we've just signed and a few more in the pipeline, we can know that it's going to be a good year. And there's also a bit of a lag in our business between sales booking a contract and them being onboarded and starting to generate revenue. And so at the end of 23, we said, we've got good revenue growth rate. We've closed a bunch of deals in the second half of 2023. That gives us good certainty for revenue into 2024. And one of the, I think the keys in any exit is you can't have this unrealistic, lofty forecast that you're putting in front of investors, because at the end of the day, the exit process will take 6 or 9 months to happen. And you need to be able to hit that forecast every single month throughout the process. And so for us, it was, at the end of 2023, we've got good revenue growth, we've got good certainty about what 2024 looks like, and we've got a good pipeline of closing that we know we can close deals throughout this process as well. So all of those things aligning was something where we said, do you know what, the timing looks quite right here. The other thing we sort of were looking at was there were US elections coming at the end of 2024, and we thought, well, who knows what's going to happen there. you know, there's a case that 2025 may not be as good as 2024. And if that is the case, then should we be bringing forward this timeline and having a go at it in 2024 rather than waiting to the end of 2025 and going to market then? And so in early 2024, we had a board meeting, and the general consensus across the board was, let's go out and kick off a process. And there was various steps that we took to get there. But yeah, that was sort of the timing of when we started.
I think just
and then you have
there's obviously, in your type of business, Nick, you know, it's changing rapidly. It was still an evolving, rapidly growing business. So I remember, you know, this time last year we were having discussions that every month the results were getting a bit better. So actually, at what point do you anchor the numbers to present to bidders? And we had some quite interesting discussions around that, because obviously, you know, particularly with your business in ARR and what defines ARR, what you can put in, what you can't, which we'll probably come to later. But you know, remember at the end we fixed it to a point, but then we ended up, because these processes do tend to take longer these days because of various market dynamics, doing another current trading update 3 months later to show an even better improved position, which so you could be more robust and more, you know, sort of real-time basis with buyers.
Yeah, that's right. And so there was a bunch of work that happened along that. But I guess, like anything, you want to be able to present the best story. And so we had a good growing business. We had onboarding clients, but then one of these really large elephants landed and started billing in June. Just as we were sort of finalizing our forecasting models and our actuals and stuff that would have been put in the pack by the bankers to go out to market. And so we originally had planned to have our forecast and our actuals locked down as at April, to then go out with the bankers with a June forecast. We ended up updating the actuals for June to have that extra month in there, because it just made that growth look so much better.
And I mean, Simon, you're obviously in receipt of these metrics and doing a lot of work on metrics in transactions like these. But I guess, yeah, it'd be interesting to get your perspective on where you've seen some of your best work on working with presenting the best position for the business, because there's a lot in how things get presented, and obviously the timing of it, but also how certain things can be recut, remeasured, or, you know, recalculated to best present certain items. So yeah, I'm interested to hear your perspective on that.
Sure, and I think there's obviously a difference here depending on if you're going down a vendor assist or a vendor due diligence route. So I mean, I'm just briefly, because we're covering more about the latter, but if a sort of a typical vendor assist role for us would be, as Nick mentioned, there would be going in earlier. We're engaging with the seller, so working collaboratively with the seller to help prepare some robust financial information. What that generally means in practice in terms of an output is a comprehensive, robust Excel data pack, which can be placed into a data room, which shows the full 3-year historical track record, plus potentially some forecasts. But the point there is this will be helping present the business in the best possible light, whilst making sure it's absolutely consistent with the marketing material, like the information memorandum and the other information that's going out to the market through the investment bankers. So what that means is, you know, keep it really simple, you don't have to present the historical statutory numbers. You don't have to present the published business numbers. What you can absolutely do is try and demonstrate the current run rate position of the business, which potentially can bake in some quite significant adjustments to EBITDA, for example. You know, when we talk about this in the context of this discussion, ARR is the most important metric, more important than EBITDA, and there can be quite a big difference between actual historical ARR and contracted ARR. Nick talked about some of the big contracts that have been won. You can absolutely, with some justification, build into the numbers an element of those new contracts, even though you haven't actually delivered the revenue. As Nick mentioned, there's sometimes a lag between winning orders and revenue recognition, but it is actually, you know, you're showing the business now, which has the benefit of those secured long-term revenue agreements. So we spent a lot of time going through that. I guess that the difference, if we just move to the VDD, and I'm sure we'll explore this a bit more, important to mention that the VDD product is an independent review of the numbers as opposed to a collaborative vendor assist helping prepare the numbers. So what that means in practice is that we actually, whilst we agree the scope with the likes of Nick and the seller, our duty of care and reliance is to the eventual purchaser. So the purchaser gets an absolutely independent review and check of the numbers. So should give them an awful lot of confidence if we talk about these types of things like ARR, and if you can present numbers, and we've been through them and we've challenged them robustly through the eyes of the purchaser, and given our view that those numbers are reasonable, that should give purchasers a lot of confidence, and also obviously provide the seller with a set of numbers that can be reviewed on a consistent basis by purchasers.
Yeah, and I think it's slightly different as well in the US. So a lot of the reports for vendor due diligence don't have that same, I guess, warranty as they do in the UK. And so I think being out for the buyer to be able to rely on the numbers a lot more and have that warranty here, I think means that they can. It makes that process a lot smoother. It means that they end up doing a lot less due diligence overall. And it means that for the team that has to work on this exit, you're not spending as much time going in and making all the explanations about your numbers and how they're built up and things like that. Just on your point as well, Simon, about the being able to present the numbers in the right way. So, the exercise that happened with Cooper Parry, they went through and looked at all of our numbers and really tested us on, well, why is there a jump in this month? Why is this month going down? What's this expense category going up? And ask the normal questions that a purchaser would normally ask in a due diligence process. And then we can get ahead of that, because in the report that's produced, you highlight all of those things, you explain what all of those things are. And so it means that if you're dealing with several bidders that get down to that final due diligence process and you're having to answer these questions, you're saving yourself hours of time by doing this several times over, because all of that's explained in the one report. And also, you can produce the numbers. So we had our normal management accounts, which are presented in the report. And then you can say, well, let's adjust for these one-off items. Or there was a billing error last September, and that's why billing was higher that month, but it was corrected in the next month, and that's why it went down. Suddenly you can just present what is that smoothed real picture, like adjusting for what the real picture should be. And then the bankers can base their financial modeling off those adjusted numbers. And it just creates sort of smoother trend curves and things like that people can then look at and rely on a lot more.
I think
Simon, do you think that? Do you think that in practical terms? I mean, you've seen a lot of transactions where VDD is in play. Do you think in practical terms it really does reduce the then onward diligence or top up diligence that's done by potential buyers or bidders? Because I hear some people that are a bit skeptical on, okay, there's a potential transfer of reliance, but surely the buyer's just going to end up doing just much DD anyway. And so do we really want to invest in this VDD exercise up front? Do you genuinely see that value?
Absolutely, I do. I do think Nick's point, it does vary slightly based on geography of buyers and type of buyer. I mean, if you think about the sort of financial buyers versus corporate, and you think about particularly the US point, I mean, you're right. The US market tends to have what's called a quality of earnings report, which is doesn't have this reliance and is a sort of scoped down version of vendor due diligence. I'm generalizing a bit here, but but I think then that's within the gift of the investment bankers early in the process to explain that to potentials and make sure that is fully understood. It depends, but certainly it allows you to prepare numbers so you can get bids on an apple for apple basis. I think that's really important. People have one set of numbers rather than building their own numbers bottom up, and then you can't always compare bids that way. I think it definitely minimizes disruption to the target's management. Nick's point earlier is very well made. You can't, as a management team selling a business, you really don't want to make that big mistake of taking your eye off the ball of delivering your results to the best of your ability during this sales process,
Yeah.
because this can be a hugely time consuming process. And if you're not having being on the front foot and presenting some sort of diligence report to others, that means you're going to have potentially, I don't know, 10 different people all asking you the same questions in a slightly different way or different questions. And, so I think it's definitely minimizes that. I think the reliance point, it definitely does make a difference. I mean, I think it's quite funny on this deal, there were some bidders who still engaged buy-side diligence advisors and asked a lot of questions, but I think it was still less questions and less invasive than it would have been without it. And crucially,
Yeah.
we part of our service in this VDD is we're with Nick and the team during those bidder Q&A discussions, and we're able to field a number of those questions ourselves and just help. We're sort of alongside Nick and the team, making sure that we're working together and we're explaining those things off the back of the work we've done. I think again is a hugely helpful thing.
I'd echo that. So our eventual buyer was Worldpay. We had some financial due diligence calls with them. I think there was 40 people on the call on the Worldpay side, most of them from PwC, and they had a list of 80 or so questions they sent ahead of the call. Simon's team pre-prepared all of those answers, talked through all those answers on the call. I jumped in every now and again to give some clarification or to further explain some of the points, but it really took hours of work away from me and my team of having to prepare all of that work and answer all of those questions. I think the other thing is in preparing the vendor due diligence report up front, you ask for a lot of spreadsheets, you ask for a lot of transaction listings, all the things that companies would ask for if you get deep into due diligence. And so suddenly you've prepared all of that work up front to create this report. And so you're not having to do it again when the exit process is busy and you've got several bidders and it's really crunch time because you've done all that work months before.
I think
makes sense.
if you look at it, there's more of an investment up front, which can be a bit painful to start with, but actually I think it's hugely beneficial because when you're in the heat of a deal with bidders, what you want to absolutely do is keep that momentum going. You don't want to lose any of that momentum, because if I've seen it on the other side when I'm on buy side, if somebody takes a while to reply on the Q&A or doesn't quite get you what you need, you start to just question around credibility and have they got this? Do they know what they're doing? Any drops in credibility will inevitably mean a drop in the value that I'm going to pay for it. So I think this really helps preempt and prevent that.
Can I just touch? There's a few questions in the chat I'm going to bring in now because they're sort of broadly around this prep phase, and then we'll maybe move on to a bit more kind of in the meat of the transaction and how things were playing out at that point. First was maybe to you, Simon, which is how would the approach differ if we were preparing the business for a PE transaction as opposed to a trade transaction? Would the VDD approach effectively be similar? Is there something different that would be in play if there was a expected PE route?
So I can probably answer that as well.
Yeah, well, you've had the same, right? But,
we didn't have we had a preference for a trade sale, but we had several PE buyers in the mix as well. And I think PE buyers generally, we got fewer questions overall from PE buyers because I think they relied on the information that was in the VDD reports a lot more. But it was the process was the same from our side of things. Yeah.
The only thing I'd say, it wasn't so much on this one actually, but PE tend to focus. They've generally got a shorter investment horizon, and they tend to focus more of their questions and analysis around the future rather than the past and the forecasts. And there is often, we have a debate when we're setting our scopes on VDD about what do we actually cover in terms of historical versus outturn versus forecast, how far the forecast goes out. I'd just say if you're thinking mainly you're going to be going to PE, it would be worth focusing more and having the VDD focus more on the next 2 or 3 years, because you'll get a real robust kick of the tires on that.
Yeah. Okay, makes sense.
Yeah,
And
I think, you know, whenever there's a buyer looking to pay several times multiples of your revenue, they must have something there that's thinking, well, how can we grow this even more? What are the synergies that we've got with our business or with our portfolio, or some ideas to scale this internationally that will grow the business a lot bigger than what the plan is that you've presented to them. And so I think Simon's right. They'll look a lot more at the immediate next 12 months or maybe 2 years, but thereafter they've got their own models
I know it's
that are sort of adding in these revenue synergies and these cross-sell synergies and these international expansion synergies and whatnot, and they'll come up with their own business case. So yeah, the 3, 4, 5 years out is probably less important, but it's super important to get the next 12 months right, because as you get through that exit, you need to hit, as I said before, you need to hit your forecast every month there, because the way that they get confidence that your forecast isn't just made up is if you hit the forecast every
you're hitting it. Yeah.
The other thing is, once you actually go through the exit, as you're staying with the business to help with transition, you'll be held to that forecast. Your new targets, if you've got retention and things like that that are packaged up into your deal, they'll be based on the plan that you presented to them. So it can't have these unrealistic, lofty goals into the future, because it's going to come back to bite you.
One question to you, Nick, which I've seen different approaches on this, but when did you tell staff, and what did you tell them at what point, basically, and how did you manage that?
So we had a core group of people, the finance team that were having to work on it, that we told early, and our senior leadership team that we had to get in on various different due diligence calls. We went through the process at the same time that we were considering starting the exit process. We also went out and looked at raising some venture debt. And so our message to staff was, we are fundraising over the next 12 months. Some of you will be called in to help us out with this fundraising process. And, you know, we'll keep you updated as we know more, type of thing. We actually got approval for some venture debt, which we didn't take because the conversations around the exit were accelerating. But that was sort of the line that most of the staff found out on the day that it was signed. And we did the big update to Worldpay, did it to their team, we did it to our team. There was a core group of maybe a dozen people that were involved before that helped out with various different calls.
Yeah. Third question on price, for Simon, probably. Price of the VA and the VDD, basically. So, like, broadly, are you able to pin a range to it? Maybe, I mean, obviously different size of business, different complexity of business models and structures, etc. But maybe just the ratio then, if you can't place an exact number on the difference between like a VA exercise and a VDD exercise, like what's the rough cost differentials?
Yeah, okay. So the answer, of course, is it depends.
Yeah.
But let me try and be a bit less of a politician. I think the VDD is a much more comprehensive. Well, vendor assist covers a multitude of different services. I think that's the thing. So it can be. We've talked across the sort of life cycle of a pre-deal exit readiness. You know, ideally, I would suggest that something like 2 years before an event, you should be doing some sort of initial diagnostic exit readiness test. You know, that can be, you know, we've actually got a thing where we'll go in and just spend a couple of days talking to people, flushing out what we think are the key issues across financial, tax, legal, and producing just like a traffic light report which management can use. You know, that can be, I mean, I'm happy to share that sort of, it's going to be less than £10,000 to do something like that, for example. It can be even less depending on what people want. If you then move to vendor assist in terms of, let's keep it narrow for now, the sort of producing the financial data pack, which can be provided into a data room, I'd say that's probably about half the cost of a full scope VDD. So you're probably talking, if I give some ranges, you're probably talking somewhere between 50 and 80,000 pounds, depending on how robust the information is and how comprehensive it is. If you're then moving towards a vendor due diligence, full scope vendor due diligence, and in our world, that would encompass financial and tax and have an element of outturn and forecast work as well. Yeah, you can sort of do the maths. It's probably double that range of the VA side of things. And
Yeah.
that would be the exercise where at the end of that you get, it's usually give or take a sort of 6 week exercise for a full scope VDD, and at the end of that you get the full comprehensive 200-page plus VDD report.
Yeah.
So that gives a sort of rough feel. Obviously it will depend on a number of factors, but hopefully that's a sort of helpful guideline.
Yeah,
Yeah.
I think from my point of view, as a CFO, you have good knowledge of tax, but you're by no means a tax expert. and I think especially around the tax side of things, there's potential things that can crop up, be they around share options, R&D, corporate tax, things that you guys will go really deep into and flag up. And if you do that far enough ahead of time, there's the time ahead of you to go and approach HMRC and get some rulings on things, or potentially correct it in your next tax return before the exit starts, things like that. We did first the financial due diligence, and then we did the tax. And the tax was kind of the tax report was finished the week before we were really deep into our due diligence discussions around everything financial. And so if I had my time again, I'd probably bring that even further ahead, because the stuff that you highlighted in the vendor in the vendor assist, we were able to sort of get ahead of that, like any sort of PE risks and things like that, and any other high level things that you highlighted there. But there were one or two items that were uncovered as we got sort of that deeper report
level. Yeah.
That we sort of then missed the opportunity to go and approach HMRC. And the way exits work is you get offers from several people, you have a deadline, you choose the one that you want to go with, and then it's the buyer's job to chip you down as much as they can from that price that they've offered you. And that might be just cutting amounts away from the purchase price. It might be holding amounts in escrow until you go and get tax rulings or things like that. At the end of the day, if you can get ahead of many of those things and take away the opportunity for them to price chip when you're deep into the end of a sale process, that's ideal. And that's going to save you a lot more money than what you're going to pay Cooper Parry to do the work, right?
Yeah.
And well, the other thing is, if you don't do this, you're still going to need advice on these things when they eventually get uncovered by PwC on the other side, or KPMG that the buyer's using, or whoever they're using, right? Someone is going to uncover these things, whether it be Cooper Parry doing it ahead of time or the buyer doing it during the process. And if the buyer does it during the process, then you're faced with having to engage your tax advisors to help write a paper around why it's justified they shouldn't price chip, and you end up paying that money anyway.
You're on the back foot. Yeah, you're paying the money for the advice, and you're getting chipped potentially on the transaction value, right? Yeah.
The key thing there is it's all linked to this common thread running through the conversation around it's never too early to start this, and this doesn't mean you need to necessarily solve everything a year before, but if you've at least uncovered and started to think about these things, and some of these tax and legal related things take time. So you need to factor that in. I think there's also a bit around, to Nick's point, it's much easier to have these negotiations when there's competitive tension. So what you don't want to do is get to like you've picked your preferred bidder and they know that and they've got the chips around negotiating. Actually, if you're actually pushing these issues out or potential issues out through some sort of VDD or earlier, all the bidders have got to make a call and they know there are other bidders, so they might be slightly less aggressive or robust in their approach, which you're on the front foot again. So I think that's another really important point. And just the last thing on tax, I'm far from a tax expert, but I do think there's also, we've talked a lot about the risks here. I think certainly again in Nick's space, in the tech sector, we do an awful lot of deals in the tech space. There are often some tax attributes in terms of historical tax losses, R&D tax credits, things like that, where you can actually, if you can identify and justify those through a VDD process, you can actually ask buyers to pay some value because they'll be taking those on. And I think that's an important thing. If you, again, flushing those out early is another important thing.
Yeah.
And
Yeah,
they can be used as trade-offs, right? So these are things that I probably wouldn't have known about. Suddenly, if they're trying to price chip, you can say, well, there's these other future tax assets, R&D, that are coming in next year, the year after. We hold value against those, so we're going to offset them against any price chipping that you're trying to do.
Yeah. And at the end of the day, as you say, you're going to end up on a diligence call with a buyer who's probably got a big four firm on the other side with 15 tax people on who are going to try and find whatever they can to take that number down. And the preparedness on that in advance is far outweighs the cost of doing the work.
And by the way, when these big four firms are engaged by a buyer, that is their sole focus, is let's uncover every stone and let's use it as a mechanism to reduce the price we're going to pay. Right? And so even though HMRC, there might be some black and white sort of tax ruling that, HMRC never takes the point anyway. It's very likely that the buyer's advisors will just take that point and use it as a method to price chip.
Yeah. In terms of during the main meat of the transaction through to completion, were there particular things? I'm also thinking from a project management point of view in terms of how you manage the tension, the volume of stuff that was going on through that process with your various advisors you had around you. But like just reflecting on the transaction through that process to completion, what did you feel was key? What was important, and maybe where did you face some challenges?
Yeah, I think so. It's always a challenge to make sure that you're not taking your eye off the business. And so part of the reason for engaging our senior leadership team was you guys are going to need to step up. You're going to have to take more leadership of the day-to-day business. You'll have to make more of the day-to-day decisions, the things you would normally come to us as founders with. See if you can do that by yourself without coming to us, because we're engaged more on the sales side of things. And so I think that's a key point. I think trying to, like, the VDD process we went through to get all of this information together up front just saved all that time at the back end. I'm just trying to think, as we got into the process, I think a lot of it then is it normally comes down to a few different items that they've highlighted as being key and going really deep on those at the end of the transaction. And that's when you'll need to engage your advisors to get some advice, and then the conversation of lawyers and advisors arguing against lawyers and advisors for a few weeks to find some common ground. Right?
I think there should be I think, without resorting to cliches, that the key here is communication as well. So if you talk about the sort of boring but very important project management of this sort of process, these are incredibly complex processes with lots of moving parts, lots of different advisors. I think on this one we should give a shout out to KeyBank, who did a brilliant job. I think from the investment banking side, they're all over the sector, and I think having that sector knowledge is super important as well, because we all knew the key things to focus on, which makes it a much more efficient process. I think just having that regular rhythm of, weekly all parties catch ups where you talk by exception around the key issues, so everyone knows and everyone's focused and we're not going off on tangents. I think making sure that we all understand the key sales messages that are going into the information memorandum, such that again we're focusing our work to robustly challenge those, and to Nick's point, go in sort of deep on a small number of key issues rather than sort of narrow across a whole bunch of stuff. I think that's super important as well.
And the bankers and Cooper Parry, for that matter, do a really good job of managing that process. Having a list of open items, being able to share that across your team that are working on this, assigning tasks, making sure that's ticked off. I didn't have the resources manage that process myself, and having someone that just completely takes care of that is really helpful, because at the same time you're doing that, you're negotiating an SPA with your lawyers and the intricacies of what the legal agreement, 150-page legal agreement looks like, and doing that whilst at the same time needing to send over different spreadsheets to different people on certain things.
Yeah.
You want someone to be able to manage all of that for you. And I think that's where the bankers can really help manage that process. And it often in the scenario here, it was the bankers working with Cooper Parry. So they'd highlight all of the questions that would come in from all the different bidders. They'd send that over. The Cooper Parry team would do the first draft of answering these, and then, with a quick review of me, it's all ticked off and done, right? And that's kind of what you need, because you're juggling a lot of things all at the one time towards the end.
Yeah. Yeah.
Right with that, Nick. I mean, obviously we've been through lots and lots of deal processes. You've been through a few yourself, obviously, but is it hot? I think you do have to yourself make a sort of conscious decision to just relinquish control a bit on that and not be the sort of the bottleneck in processes. And did you find that difficult? How did you make that work?
Yeah, I think it is tricky, but I sort of was very aware that as much as I like to control things, there was no way I could do that by myself. So I was more than happy to have the help.
Yeah, I think the sort of having the VDD, the formal VDD exercise done, if you like, in advance of the transaction, you're probably already on the path with investment bankers anyway, and you kind of know the event is going to happen, or at least the go-to-market is going to happen. So the investment on the VDD for me is probably a little bit more obvious. I think the bit see people struggling with from a time perspective is investing in that prep phase before that, not being sure exactly when the exit process might kick into gear, but investing, frankly, cash up front in preparation for whatever, some of the areas we talked about. But I think the key message, and Simon, it might be useful to get a perspective on this, is that doesn't have to be expensive.
Absolutely.
Like there can be like quite a bit of work done just to start the conversation without actually investing. Because VDD, I think, is an investment, but you're going to be paying for it probably on the other side anyway at some point somehow. But that kind of vendor assist bit up front is the bit where I think probably seen as a bit more optional, and maybe is a cash outlay people are not sure about. But yeah, Simon, good to hear your perspective on that, because I think it's a piece that some people don't get to.
Yeah, I agree. I mean, I think again, one size doesn't fit all here, and I think that's the important message. So, as I said, hope that sort of very initial type diagnostic piece can be a remarkably quick and good value piece, which people can do it themselves if they have the the knowledge and the capacity to do it as well as initial thing. So I think what's the key message? Key message: you want to try and flush out sort of 18 months to 2 years in advance of an exit, if there are any red flags that you need to fix or start thinking about. And that's across the whole financial, corporate governance, management, succession, value proposition, tax structure, legal structure, etc. Right? That can be a very quick initial piece of work. I think that if we take the vendor assist around preparing numbers, robust numbers, again, you can phase that. You can break that into generally with an information memorandum, the financial section only covers a small amount of the financial KPIs of the business. You could cut your cloth and produce an initial piece of work that just justifies those key numbers. And then depending on the appetite, they'll take that to the market. If you get a whole bunch of interest and it sounds like you're really getting some momentum, you could then do a second phase and build out the rest of the data book. So there's phasing ways, and that obviously helps from a cash flow perspective and from a more feeling certain that something's going to happen. So it's a worthwhile investment. I mean, I'd always say it's a worthwhile investment anyway, as well, because I guess whether you use us or another provider, whatever, I really, if you're working towards a sort of once in a lifetime type deal, or some sort of succession, or a deal that you've built up a business, you've nurtured a business over decades, you want to get it right and you want to get the best price. And I think this is a relatively small outlay, and if you actually think about the multiple on your business and the value that you're going to be either creating or at least not destroying,
Protecting, yeah.
it more than pays for itself.
Yeah.
I think one other final thing to add there as well, I think, is just the timing of things. So you want to make sure that every buyer is working to the same time frame. You want to make sure they're getting the financial model at a similar time, the pitch decks, the data room to go through, and you, by doing the work up front and presenting them with a report that answers all of their DD questions as much as possible. There's always going to be extra, but answering as many of those as possible, then you can put them all on the same time frame. You can create this scenario where everyone is working to these timelines and everyone knows that everyone else has got the same information.
You're in control, yeah.
And we're in control because, you know, and we were lucky we went through that experience. But the flip side of that would be, you know, one of the buyers can't do a DD call for 3 weeks and you've got someone that's super keen, and do you want to be trading off like someone that's super keen just to wait an extra few weeks to get back from another one? And so creating this timeline where everyone can work to the same timeframes just means that you can play one off against the other. Yeah.
Which, if you've got VDD in hand, gives you a head start on holding that timeline, right? Because otherwise it just ends up with divergent timelines. Just a question to cover. We've got 5 minutes left to cover a few questions. There's one on audited financials in the exit process. So obviously, Ravelin, Parry was signing off the audit. I was signing off your audit for a couple of years in advance of the transaction. But maybe to Simon, if there's no audited numbers in place, can you expect a different level of diligence from potential buyers? And I guess the summary is, how important is it to have a set of audited numbers in the transaction?
Yeah, no, I don't think it does make that much of a difference, because the key for us is we will be anchoring back to, you know, core management financial information anyway. As part of this exercise,
on a VDD exercise.
Yeah. And as part of this exercise, we will obviously be robustly testing that. And this reliance point is relevant here, I think, where the purchaser can rely on the work we're doing. I think it's probably more a thing around when you're planning and you are preparing for sale. You know, there's a couple of points here. There's a timing point about getting your timing potentially right. There are some efficiencies around an audit year end, and if you get your numbers scrubbed for the audit, it's a good time to base your VDD, and it will probably minimise. There are efficiencies, and you can minimise the additional cost and work around the historical VDD on that. That's one point. I think the other thing is, if you're not audited and you're perhaps, you know, it's not as robust a year-end process as if you were going through an audit, you just need to factor in a bit more time yourselves to properly scrub the numbers such that they are to that sort of audit standard.
Yeah. I mean, from my perspective, there remains a risk, you know, that there's something in the financials that isn't being accounted for correctly. You don't want that coming out in a transaction after you've appointed investment bankers and you're going into VDD and it's found at that point. So the question is, how do you find it before? How do you protect against it coming out later? One is an audit, or two, you know, is some other form of, you know, review process. But
I was going to say, it probably gives more credence to the vendor assist product as a way to help prepare robust numbers.
Yeah, agreed. Another question around, you know, all of what we've been talking about in terms of process and the process of VDD and VA. You know, is this the same regardless of size? So, you know, was regardless of size of the business in you know, going through the transaction event, do you see big differential? Obviously, there's different values attached and risk attached, but is it largely the same if it's a 20 million EV versus 100 million EV? Like, what's the difference there?
I actually think the VDD side of it is more sensitive to, like, the sort of number of bidders that you're going to go to and the competitive tension that you're trying to retain. Because, you know, if you think this is you've got one or two preferred people that you think are going to snap it up, you could probably manage that process much more easily without sort of VDD side of things. If you're going to a wide buyer universe, which encompasses, I know you're going to have 5 to 10 potential serious bidders that you're going to take through to this phase, that's when VDD comes into its own, to this point around minimizing disruption, having bids that are apples for apples, being on the front foot, all that sort of thing. There is obviously a cost implication as well, right? You've got to think through the cost benefits, and you know, it's not just us. I mean, we talk about VDD and VA, but you know, the wider legal fees, the investment banker fees, these are expensive processes. So I think you need to weigh up your sort of overall advisory cost as a percentage of deal size and work out how it makes sense. You know, if you're willing to take you know, we might lose X 100,000 of value, but actually we'll save an equivalent amount in fees, then I could understand the conversation.
That's the balance. Yeah. Cool. Look, we're up on time. It's 2:00. I covered all the questions in the Q&A as well. So thanks for the guys dropping questions in there. Really appreciate you jumping on, Nick, and joining us. There's a lot of great insights there, and Simon as well. This will be recorded, so if anyone wants to share it or look back, you can find it shortly on the recording. Also, anyone that's looking for more webinars, we've got a US expansion series ongoing at the moment. There's 2 more in the three webinars that we're doing coming this month, so look out for those. Find them on the website, and appreciate you jumping on. And any questions after this, then drop us a note on email, and we can do follow up. Cool. Thanks, guys.
Thanks, everyone.
Bye, guys.